Hi, Thomas. How are you? So nice to see you.
I'm all good, Bogumiu. Like, very happy to be on the show with you.
Well, a few weeks ago, you and I had a nice chat and we talked about investing and your life and your story. And I thought we have to sit down and record because there are some beautiful lessons that you have that you could
Mm.
share. Let's jump right in. You know that I like to ask my guests about those early days, childhood
Mhm.
upbringing, and how you think that time shaped you and especially your relationship with money. And I know you have a story.
Yeah, my childhood was it was pretty rough, particularly because my dad, he was pretty addicted to not just alcohol, but also gambling, right? So when I was 9 years old, he sort of stopped working altogether because he was always either gambling or out there drinking with friends. So financially, life was very tough. We didn't have a lot of cash flow coming in, and frequently my house, the bills, the power supply, the electric supply would be cut. And frequently, I remember back when I was in school, I would frequently be called out by my teacher, to give me a friendly reminder that the school fees are due, and it's been due for a couple of months, and somehow or rather, I will need to settle the payment of that. And going through that sort of experience, when I look at my parents and I look at my relatives around me, a lot of them didn't know how to manage money very well. They were either living paycheck to paycheck or they were borrowing money. For my dad, it was very frequent for him, like in the Asia context, to pawn away my mother's jewelry, right, to get cash for that. And so when I look at something like that, it is very heartbreaking, right? It's very heartbreaking for my mother. It was very difficult for me to see that happen to my family. And so I went around looking for answers, and I think this is where luck played a very important role in my life. Because it was always very messy in my house. There was always fights breaking out. I mean, and there was also like lack of power supply and all that whatnot. So I frequently just stayed in the library and spent most of my time reading books. And it was really through luck that I came across the book Rich Dad Poor Dad. That was my first finance book, like personal finance book. And a light bulb went off in my head back then when I was just a teenager, when I read that book, because it offered some hope that I could eventually get out of the rat race, right? Because in the book, it talked a lot about how people live paycheck to paycheck. And unless we actually start to accumulate productive assets, money that starts to work for us even while we sleep, it's very, very difficult for us to be financially independent in life. And when I read that, I was motivated. I saw hope, and it led me down a path to spend almost every free second and hour of my life studying about investing and to read more about personal finance, um, behavioral psychology, and all that whatnot, because I really wanted to get out of that poverty cycle. And it was through years of reading, going straight into the market, learning, and then also learning from mentors and all that whatnot. It eventually led me out of that poverty cycle. And I guess that entire journey made me a pretty conservative investor, which made me come up with the name, the word steady compounding, that, for my blog or that's typically my branding, because I don't believe in quick riches or building anything that's fragile. Whenever I think about wealth building, I want it to be resilient, right? And so whenever I invest or look at companies, I'm always looking for steady compounders, companies that has a wide moat that's able to keep on growing and compounding my wealth over time.
Well, that's quite a story and an inspiration for everything else that you're doing in your life, and it's really amazing how you got attracted to the slow and steady way of getting rich, because I think a lot of people get into investing to get rich quickly.
Right.
Let's so the question I have for you, and one of the stories that you shared in your writing that really spoke to
Yeah.
me, was about leaving what you call the iron rice bowl. And I'm curious for you to explain what it is, but you talk about minimizing regrets, taking risks, and making a jump, and getting outsized results. Tell me more about that story.
Yeah, so the iron rice bowl is a very commonly used term in Singapore, right? The term itself, when we say iron rice bowl, it means it's a career that's unbreakable. So for me, when I was growing up, because of the financial problems, I took on a bonded scholarship with the Singapore government. So in a way, they guarantee me a lucrative career after I graduate. But at the same time, while I was pursuing my education, my degree in finance, they pay for not just the tuition fee, my overseas exchange, my accommodations, and at the same time, they give me a very tidy allowance. So this not just allow me to just focus on studying, on my student life, but it also pays the bills. So during then, I knew I had to sign this scholarship, even though I already knew I wanted to be in the investment field. So the day I signed the contract was the day I knew I was going to quit eventually, right? Because I knew that my passion really stayed with investing, yeah. And I when I signed that at around 18 or 19 years old, I scheduled a delayed message to myself 1 year before my contract would end. So after graduating, I had to work with the Singapore government for 4 years. I know by then my career would sort of have taken off, and I might be too comfortable. And I was afraid that I would be so comfortable that I forget to pursue or be afraid to pursue what I really want to do in life. So I sent that 1 year titled "What's Next" right before my contract came up. So when I received that reminder, right, it was scary, but I knew I had to do something. And the reason why I scheduled it 1 year before my contract ended was because I knew it wasn't going to be a very smooth transition, right? I do have a finance degree, but so do like thousands and thousands of other people. But and I had to stand out because
Right.
I didn't have an experience on my CV that showed other than a finance degree, right? My CV, my experience was with public service. So I knew the transition wasn't going to be easy. And so the first thing I did was I went on LinkedIn. I started to reach out to a lot of people in the industry, and it was crickets, right? Because and those who replied me told me it's going to be a very tough transition because I don't have the
Right.
experience to show for it. So when I encountered that, I thought of what I read many years back, which is called Third Door by Alex Bunyan, right? He says like the mainstream way of getting into any career that you desire, of getting into anything that you want, anything worth pursuing, it is going to be extremely competitive. And what we want to do in life is that we
Right.
want to look for that third door, right? That door that's non-crowded. And to me, back then, I thought about it hard, and I felt like a good way for me to start getting to know people, or getting people to know that I actually know what I'm talking about when I'm talking about investing, was to start writing online. And so that was when I started a blog, steadycompounding.com, and I started to share my investment theses and everything I know about investing. And unexpectedly, it went very viral. And eventually, a few people from Twitter started reaching out to me. They told me like, at the way I'm writing, I have to go on Twitter. And so what went from like 10,000 views became like a few 100,000 views, and then eventually it hit like a peak of maybe 5-6 million views. And that was when I felt, perhaps it's time for me to, make a pivot. Originally, the intention was to get a job in investing because I love investing. But now I'm given the opportunity to monetize my presence online by doing the kind of work that I love, which is essentially analyzing companies, while yet at the same time, getting to network with a lot of remarkable investors out there. And once that light bulb went off, I knew I had to dive into this 2 feet in. Leaving the iron rice bowl, quitting the job was something that was definite for me. but not pivoting into another, investment career, the typical career path. That was a little bit scary. And that was when, I was reading up on what Jeff Bezos actually did. Because even for Bezos, when he quit at the peak of his career in a hedge fund, he was making a very sizable chunk of money, right, on an annual basis. I believe it was
Right.
way above 100K, $100,000. And during, before the year 2000, there was a huge sum of money. And when he asked
Yeah.
his boss back then, his mentor, whether he should quit his job, they told him he was crazy, right? To start something that nobody has heard of, right? Before 2000, nobody has heard of, starting a store online, and you wanted to sell books online when you are already making it. You're doing very well in your career. That was crazy. Yeah, but Jeff Bezos,
Right.
that was when he relied on this framework whereby he imagined himself to be 70, 80 years old, and he asked himself, what would he regret doing, right? And he called this the regret minimization framework. Whenever we are encountering a very difficult decision in life, we just confer it over to our 70 or 80 years old self. And a lot of times, the
Right.
biggest regret in our life is not the things that we do, but it is the things that we didn't pursue, right? And
Uh-huh.
when he thought of it that way, it became very clear to him what he needed to do. And when I applied that to myself, right, given the set of opportunity I have today, and when I imagine at 70, 80, would I have regretted not giving myself a shot? Then the answer become very, very clear to me, right? Because there was a clear audience traffic, a product market fit, and I had to give myself that shot.
I love that. I mean, so many things that you mentioned, but I think we all have moments with the iron rice ball of our own lives where we feel very comfortable and taking risks
Yeah.
feels like something that we probably shouldn't do, yet everything we want is on the other side of it. And I like the idea of minimizing regrets or minimizing, losses as a big picture investment philosophy. I always say that I want to be the least wrong, right? I
Right.
don't have to be right. And I think the staying power that you talk about, the steady compounding, that's where the magic happens. So, and I like that you mentioned the third door. It happens so many times in our life, in our careers, that it feels like
Yeah.
there's just the obvious door that everybody's running towards. And some people see the second door, but there might be yet another way to go about it. And it was beautiful what you shared, and you told me that weeks ago when we spoke, how everybody told you, well, it will be really hard. There are always people that will tell you that something
Yeah.
is really hard. There's no shortage of those voices. But you found a way that really resonated with you and allowed you to pursue something that you love doing in a way that resonated with so many people. So I think it's it's a huge inspiration for anybody wanting to pivot or figure out a way to pursue their dream, whether it's investing or something else. You have another visual in one of your articles that really made me pause and think. You call it the S curve of life. Can you
Right.
talk about that? How it works, how to think about it? And I think it's a great image that to have in your mind when you're thinking about pursuing something, especially something that will take more time.
Yeah, so the S curve of life is pretty much like a business life cycle. When a young startup company, when you first begin by pouring in a lot of investment. So that's sort of deep for a while. Then after you begin to find your product market fit, you start to take off, you start to rise. And for a lot of companies that don't innovate or make the pivot, they sort of go down the curve again. And they sort of just go into a gradual decline. So that's like a S curve lying on the side. And the same things goes for us, right? We start out first by putting more in. It could be education, it could be our time and energy in mastering a skill or craft. And when we graduate or have mastered the craft, our careers start taking off and we start rising for a couple of years. And once we hit the peak, that's when a lot of us would feel like maybe our jobs is no longer as meaningful as it used to be, or it is as not as challenging, as it once was. And I think a lot of us would run into what we call either quarter life or midlife crisis by then. But the key to this is to find our next curve while we are still climbing up. And that is the most difficult thing to do, right? Like we were talking about earlier, whenever we want to do something different, there will always be people who are telling us, it's a bad idea, or there will be voices in our head telling us, why do this? What if we fail? And a lot of times, these voices in our head would prevent most people from taking action. But starting a new curve is very important, because otherwise, when you are starting to trend downwards, that's when we lose a lot of meaning to what we do, and that's where a lot of us stop reinventing ourselves. And whenever I think of this, I always remind myself of the Benjamin Franklin quote, right? Most of us are dead at 25, but we are not buried until we are 75. Yeah, so this is how I think about the S curve in life. We always got to reinvent ourselves or start something new before we start going downhill, right? And the best time to reinvent ourselves is always when times are good.
It's easier said
Yeah.
than done. Somehow in difficult
Yeah.
times, then we get a bit pressured to actually make an effort. But I think to me, what really spoke to me and what you just mentioned is that you have this initial effort, and it kind of feels like you're actually going down instead of going up, right? If you're learning a new skill, if you're changing careers, even if you're changing the way you invest, at the beginning it may look like this is actually worse outcome than I expected. And only after a while, after you invested time and effort, you see that, it starts to climb up, and it may take you to a whole new level that you wouldn't experience had you just stayed the course that you had initially. And I think that's where the magic happens in any learning experience, any change, that it is a
Yeah,
bit of
I
a
think
dip at
that's
first, and you have to just keep
yeah,
going.
that's a great point you brought up. Like even for Buffett, the way he started managing his fund, he chose to close it when his fund was doing very well, but he couldn't find any opportunities in the market. And then when he reinvented himself, that's where he acquired Berkshire Hathaway, and even further down his career, he started to change the way he invests. I'm sure like throughout all these changes in his life, it's not easy, but we sort of have to do it as we continue evolving throughout life.
When you flip it on its head for a second and you assume that you learn certain skill by the age of, I don't know, 22, and you'll
Yeah,
never change, right? When you
yeah,
think about it, and you might be in the field for the next 60, 70 years, you're missing out on so much, right? Because the world
yeah,
will change around you. And you took, Buffett as an example, but the majority, more than half of the value of Berkshire Hathaway is in a big tech company these days, Apple, right? It's
yeah,
such a long way from the kinds of businesses that Buffett was chasing when he was Graham's student back in the day.
yeah,
I don't know if it was 70 years ago or 80 years ago now. So when you think about it, he allowed himself to continue to learn and change and grow. And we're talking about someone that remembers the Great Depression, and here he's
yeah.
invested in smartphones and technology and things that I don't think anybody could have imagined when he was a kid. So I have great respect for people that continue to learn and challenge themselves,
Mm.
and see that at the beginning, that kind of shift might have the S-curve shape that you talk about. I was reading your biggest takeaways from 2023, and there are many, and I like them all, but there was one that really stood out to me. You said it's difficult to fail if you love the work you do. Can you talk about that? I think failure is something that, the fear of failure at least, it's something that stops us sometimes. You have a different take on it.
Yeah, so like I think the fear of failure certainly does prevent a lot of people from starting or pursuing their dreams. Even though sometimes the downside might not be exactly that high. And the truth is, even when I first started steadycompounding.com, it was anonymous. I did not let myself be known, because it was really the fear of failure that made it very difficult for me to put myself out there. But that was when I was reading a lot of other books. I always turn to books for answers, and one thing I believe it was from Tim Ferriss's books. Most of the time, people don't care about us as much as we care about how we portray ourselves. And I think it's really the biggest preventer of success, or the biggest killer of dreams, is just fear of how we are being perceived by others. When I think of it is difficult to fail if you love the work you do, right? I sort of got this idea from Naval Ravikant. Um, this is his quote: "Do what feels like play to you, but work to others." And that thing was another light bulb moment for me, because whenever we think about playing games, right, it becomes very easy when we get
Right.
sucked into the game, right? We enter into this flow state. And if it feels fun for us, we have so much more energy in troubleshooting, in overcoming the challenges. And when it feels like work to other people's and feels fun to us, naturally we gain an advantage over all the competition. Because right now we are more creative, we have way more energy to tackle the problems we are solving. And even for myself, when I'm doing whatever I'm doing, it doesn't feel like work at all. Like writing, thinking about investing, analyzing companies. And that makes it very sustainable for me, as opposed to when I was hustling when I was way younger, taking up jobs I didn't like, but just because it pays bill. Um, we can get good in those things, but I think to achieve mastery, or to become like really the top few percent in your field, you need to be loving what you do, because that's when even challenges that flies in your way, you would have so much fun solving all these problems. And throughout this entire journey of solving problems, overcoming challenges, that's where our skill sets compound.
I like the sound of that. And you said a game, and we'll come back to the term game later in this conversation. I
Yeah.
have a question about it down the road, but it made me think of a book I'm reading by Ken Honda, Happy Money, that you might be familiar with. But his idea is, many ideas, but one that really resonated with me is, if you see money as a game, right, you can see it as winning and losing, or you can just have fun with it and see it as a play. And I think the point that he makes, that he interacted with two kinds of wealthy people, the happy ones and the unhappy ones, in very broad terms. And the happy ones are just having fun with just the game itself, the pursuit. And here you can call it a process, and chopping wood, and whatever people call it, carrying water. But if you love the process and you have fun with it, the money will follow if you have the right principles that you talked about early on in this conversation that allowed you to really set out on this new course. And it reminds me of a conversation I had with Luca Delana on this show, when we talk about the joy of playing a game that has no end, and that James Cars with infinite games, and the goal is to never participate, from Luca Delana's perspective, in a kind of a game over situation, which really matters in investing, where you don't want to have a scenario that would completely derail your financial well-being. But I like this concept of a play, and Happy Money and Ken Honda have a great way of presenting it. And you mentioned how if you're loving what you're doing, you can't really fail at it, right? Like, failure in my mind, it's when you put on a very strict goal target and you don't meet that target. I don't know, making $1 million by next year, or by your 30th birthday, whatever it is, and you feel like, I haven't achieved it, so I failed. But it's putting this whole problem in the wrong context, right? If you enjoy the process, whether it's stock research or it's the saving itself, if you make this the joy and the fun and the play in itself, good things will happen, and the failure kind of vanishes and disappears. I think it's a fun way of looking at it. I want to ask you about filters, and you talk about it. You say you become what you feed your mind. And the reason I want to bring it up is that I realize, watching investors and talking to many, and having been in the business for 20 years, is that if there are many secrets or many principles, but one of them is to create a certain filter, and many of them, that kind of protect your space, especially your mental space. Can you talk about that? How do you think about feeding your mind in a world where there's no shortage of things that we're supposed to read, listen, or watch, yet we have to have some really strict filters to decide what actually should should be let in.
Yeah, so I mean, I was just listening to Morgan Housel's podcast while I was jogging today, and he mentioned something, that left an impression. We are twice as informed today because of all the social media and all the digital mediums, but we are half as productive. And the truth about our information diet today, it is filled with a lot of junk, right? And the modern devil comes in the form of cheap dopamine. And a lot of people, whenever we don't curate our information diet, we get intellectual diabetes, right? And just as eating healthy is very important in our life, we must fill ourselves with nutrient-dense information and not allow the mass media or just online algorithms to curate our information diet. And personally, for myself, I'm very strict with the type of information I consume. If it's Twitter, I will use a lot of mute words, or I'm very selective with who I follow. The people I follow, I would rather they talk about, real analysis, not trying to trigger FOMO or not trying to, make predictions or forecasts for the sake of gaining followers. Because whenever we look at the mass media, it could be CNBC, it could be Bloomberg, or even some of the influencers out there. They all know this. The truth is the best kind of content that grabs attention is going to be pessimistic content. It is going to be forecasts. Because everybody's attention is limited and we are bombarded with thousands of information every day. And the only way to get us to focus on whatever they are writing is to make it sound like a very serious problem. And we have to give our attention to it. Otherwise, we may be hit from our blind side. But the problem is this: when everything sounds important, critical, urgent, it's going to affect the way we behave and it's going to affect the way we think. And so even for myself, I consume very, very minimal news. And a rule of thumb for myself is if the news is truly important, usually it will come and look for me, right? I don't need to intentionally go and look for itself. Yeah. So whenever people ask me how do they curate, their information diet, be very selective with the Substack that you subscribe to, the newsletter that you subscribe to, who you follow on social media, and the kind of words you want to block out on social media. So if something that is trending but is non-relevant to the kind of content I want to look out, I will just mute that word out together. So for example, I will mute out Bitcoin. I will mute out certain things whereby it attracts the wrong crowd to my investing style. I don't want to trigger the crypto people today, but in case it's not in accordance to my investing philosophy, or if it sort of messes with my head, I will just mute the word to prevent all this information from entering my mind completely.
I like the sound of that, and I think it takes a lot of discipline, and you have to be very deliberate about it. And I think it's something that may come with time. I remember that in the early years when I joined the investment profession, I felt like I have to know everything, have an opinion about everything. And then I realized it doesn't work that way. You kind of have to really focus and then pay attention to fewer things, but truly pay attention. And to me, a good gauge is how long it took to produce a certain content, right? If somebody wrote something deeper and more thoughtful and it took hours, maybe weeks to write it, and then somebody writes something that's a single sentence that took 5 seconds to write, I think that's a good gauge of how much attention you should give to it. But it's a tricky world to navigate, and I think it's a great test for a lot of people to figure out what is it that they should pay attention to. I want to go back to the concept of games. You have this one sentence in one of your articles that I really liked. You say how we should play long-term games with long-term people. I'm a big fan of anything long-term. I think the magic really happens when you can look at the long-term, especially when it comes to investing. Compounding, and you and I are talking about it really pays off after a while. At the beginning, if you look at a compounding chart, it's a small difference, but then it really takes off. And the fact that Buffett had made the majority, or I don't know, 98% of his wealth past his 50th or 65th birthday or so, it gets you thinking like it's something that really takes time. But tell me about long-term games with long-term people. What does it mean to you?
Yeah, I think it's you hit the nail on the head. Like all benefits in life is going to come from compound interest. It could be money, relationships, learning, or health. And whenever we think about compounding, there are two main factors that will determine your outcome, right? The rate at which you compound and how long you compound for. And if we want to be successful, we often have to work with other people, and we need to figure out who we can trust over a very long period of time. And we want to be able to keep playing the game with them and collect the reward at the end of the project or collaboration. And whenever there's trust, there's a stellar reputation, it makes it a whole lot easier to play this game. You don't have to second guess this person or anything like that. And so for me, I always like to surround myself with people who are not just kind, competent, but also people who adopts a positive sum mindset. Right? We are always trying to grow the pie for everyone. And it is also not just a better way of doing it. It is also way more fun to hang out with people like this, people who are always looking out for your best interests, and we always try and leave more on the table for the other side of the party. And when it comes to playing any sort of game, I just think that the less crowded, the less competitive area is always the long-term one, and the returns are just much greater and it's way more satisfying.
You realize very quickly in the investment world that if you're willing to wait a few months, there are fewer people. And if you're willing to wait a few years, there are even fewer people. And if you think of a 10 or 20-year investment horizon, you might be the only one left in the room. A lot of people say that they're long-term, but I always ask, what do you mean? And it means different things to different people. But if you're investing money for yourself, for your future self, you wrote this letter to your future self to quit your comfortable job and go out into investment world. But when you think about the future self that will benefit from the capital that you're compounding today, and you can think of that person in 10, 20 years, or it could be a child, a grandchild, a nephew, a niece, or just yourself. 20 years, right? If you think in terms of 2 decades, your investment decisions will be very different. First of all, you won't be swayed as much by the short-term cyclical movements of the market. And then you can take a truly long-term view about each and individual business. What is it that it can do? How can it impress me over the next 20 years? That's how I like to think about it. What kind of businesses are worth holding? And speaking of businesses, I want to ask you about growth. And the reason I want to ask about it, I think that's a story that comes and goes, and the market gets obsessed about growth at any cost. And sometimes to the point that it's top line growth, but at a huge loss with failed unit economics. So basically, the bigger they get, the more money they lose, and there's no way out of it. Can you talk about growth, how not all growth is equal, and how sometimes it doesn't make sense to chase growth for the sake of growth? That's something you write about, and I find it very appealing.
Yeah, so this was a piece which I wrote for Business Times. And when we see like what you mentioned, a lot of company chasing growth, especially during the year 2020, it is only when capital become expensive and the tide goes out, then we start to see who's been swimming naked, like who don't have a viable business model at all and struggling to turn a profit. And I think whenever I think about this, I'm always reminded of Tom Murphy, right? The former CEO of Capital Cities. He has this quote which sums this up perfectly. The goal is not to have the longest train, but to arrive at the station first using the least fuel, right? And here the train symbolizes the size of a company, right? The goal is not to grow as much as you can, it's not to grow an empire. And the fuel in this quote represents the capital required to grow, right? And a lot of times, whenever we are thinking of growth, we need to think how much capital is needed for the company to grow, right? How much capital will be locked up. And that's when the concept of return on invested capital becomes very important, because whenever it comes to growth, it only makes sense if the returns on invested capital exceeds the cost of capital. Otherwise, the company is
Right.
just going into value destruction. And the example I like to give is like, take Starbucks, for example. In the year 2000, when they were
Mm-hmm.
growing extremely quickly, right, over expanding, it led to internal competition amongst its stores, customers, and the store started to see very rapidly diminishing returns. And this comes when 2008, when Howard Schultz returned, he announced the closure of over 600 outlets and led to restructuring costs of
Mm-hmm.
over 267 millions. And this is a very good
Right.
reminder that, whenever management is pursuing growth, sometimes when we look at the proxy statements, they are compensated that way. It's always not good news when management just simply focuses on empire building, because that might not be what is building the most shareholder value for us shareholders. And when I think about this topic, I recently read an article by John Huber, right? He gave an example of AutoZone. This is a company that don't
Mm-hmm.
spend a lot on growth, but because they are very
Mm-hmm.
shareholder oriented, right? The company, rather than pursuing growth, they were buying back shares hand over fist, right? And over the past,
Mm-hmm.
in more than a decade, they were giving returns of, I think, 17 to 18% per year, even though they don't achieve much growth. So when we are looking at
Right.
investments, it is not growth that is always the most important. When we are thinking about creation of shareholder value, there's always a few prong. Growth in net income or free cash flow is one of them, but we are also looking at how much outstanding shares or how much dividend the company could possibly be giving. So we always want to look at it in totality and not just in one prong. And we always want to see if whether the returns on invested capital, does it make sense for the business itself, or is the management just simply focusing on empire building?
It almost feels like companies have to learn how to grow, because at the beginning,
Mm.
when they see the growth is coming, it's very alluring to grow faster and faster and faster. And Starbucks is a good
Yeah.
example, but there are quite a few more that happen in our recent history where companies were out of control growing. And in a way, I think the pandemic and the big shift in demand and supply that happened in 2-3 years, first it dried up, then it came back, now it's normalizing, has tested those companies, and a lot of even tech companies that are more on the growth side of the universe realized that we have to think differently about growth, both in terms of hiring, which products, which product lines to put money behind, and on and on and on, and how to use capital. So it's fascinating to see that throughout history, you have companies all the way,
Yeah.
the ones that are selling us cups of coffee, to companies that are
Yeah.
selling all kinds of
Yeah.
sophisticated tech, realize there are all kinds of growth, and not all growth is good. And it takes a lot of discipline to grow the way you described, in a responsible way. And it's fun to watch it. And it's almost like watching children go through school and making the same
Yeah.
mistakes, right? You talk about the life cycle of a business. In those 2 decades,
Yeah.
let's say, they can go through a lot of different phases. I want to ask you about your teaching experience. From what I know, you're teaching about money and investing in a village. And I even saw a picture of you holding a goat. So tell me more about this experience. What's it like?
Oh yeah, so this one, I mean, when I went there, I wanted to try living, like in a rural village in Japan, right? Just to see, as a person who's been living in Singapore, which is essentially a city, how would it be like? But when I went there, that was when I started talking to a lot of people, and there was a lot of other people in the village who started investing during the 2020 period, right? Because COVID lockdown, they had nothing to do. A lot of people started entering the markets. And for a lot of people who entered during this period, they have no investing background. They didn't study financial statements. And a lot of them, when they purchase companies, they just purchase based on recommendations. And a lot of it was very FOMO driven, right? A lot of it was very greed driven. And when I asked them, like, why do you buy this company? They would just tell me like a certain influencer was recommending this on his or her social media. And a lot of these influencers,
Right.
they are lifestyle influencers. But it was during this period they started to pick up investing as well. And so they just followed
Of course.
blindly into a lot of these companies. And as I was walking through like the financials of this company, for them, it looks like an absolute disaster, right? They are not making money.
Right.
Even the revenue post-pandemic, it is no longer growing. So it is quite a conundrum. And when they ask me what should they do, right? And I ask them to tell me very truthfully, right? Are you someone who will go and study the financials, study the annual report of this company to make an informed decision? They say no, they have zero interest in doing that. And my
Right.
advice for investors like this is to just sell whatever you have, because these companies, they don't look good and you don't have the intention of actively studying about these companies. Sell it, take the loss, and then reinvest the money into a diversified basket of securities, right? Diversified portfolio. It could be index funds or anything, right? And adopt a more passive investment strategy, right? But whenever I tell them
Right.
this, they become very uncomfortable with this advice, and it is something I think I sort of take it for granted whenever I chat with seasoned investor like yourself, because we are all very familiar of the biases that Charlie Munger is always talking about, right? The sunk cost biases, the loss aversion biases, because taking losses just feels very painful. And even though we should be making decisions based on the future, it's very difficult for them to realize the losses now, because then it feels very, very real. And a lot of them, eventually they will say, it's already down more than 90%. What more can I lose, right?
Right.
Whenever I hear something like this, I will always,
The rest of it. The
think
rest
of,
of it.
yeah, I mean, you still can lose some of, you still can lose everything else. So I mean,
Uh-huh.
I will teach them not just about how to analyze companies, but also very importantly and very under discussed, the behavioral biases that plagues a lot of investors. And the right way to think about investing, you have to always apply a lot of the mental models that Charlie Munger is always talking about. And yeah, I mean, it is. I don't think they followed my advice, because I think it's very tough for them to swallow the losses. But I think for most people, if we are honest with ourselves and we know that active investing isn't for us, then I think the passive approach is the right way to do it. And more importantly, we don't have to make our money back the way we lost it. Yeah.
I think you're touching on so many interesting points. First of all, I agree that when you talk just to investors, seasoned investors, you might assume that everybody thinks that way. Everybody has
Yeah.
had bad experience, losses, learned, and has some respect for what the market can do, and grew the appreciation for the fundamentals. Why is it that you actually own those stocks for the businesses that are behind them? But I think those experiences of teaching people that have little or no exposure to investing, I think it allows me to appreciate how some of those things are really not that obvious, and they go against our nature, and people get into investing for all the wrong reasons. I mean, we all want to make money quickly and easily, and the stock market seems like a place where maybe that's possible, right? And then
Yeah.
you realize how you can get really lucky with very little preparation, usually for a brief period of time. And it's very alluring. And
Yeah.
I think to see that other side and realize that's what's happening. And I think what also happens in my mind is that when you look at the stock market, right, as a place where you can go and change the cash for shares in different companies. That's all it really is, right? And once you have a collection of those businesses, they could close the stock market for a year and you'd be just fine if you know what you hold and why you hold it. But when you think about who is on the other side, right? You're buying a stock and the stock continues to go down, which happens to me quite often. You realize who is behind who is on the other side, and their intentions, their goals, their time horizon, their perspective can be completely different than yours. I think those experiences that you're collecting through your teaching, I think allows you to see all the participants. And I think you have a beautiful recommendation for them, which is not everybody has to be an active participant in the market, but you can still benefit from the success of those businesses through a more passive way, which is good enough. I think that's your thought.
Yeah, and I think one of the toughest things during that period was that a lot of people were seeing like their friends or their colleagues get rich because of the Wall Street bet phenomenon, like playing around with GameStop and all this. And I think it is when you start seeing everybody start making a lot of this easy money, that's where a lot of them started diving in at a very, very bad timing.
I think JP Morgan 100 some years ago had this saying that neighbors getting richer faster than you gets in the head of the investor. I'm paraphrasing, but that was the idea. And it's interesting, and I think Munger said it, that it's not greed, it's envy that gets us in trouble in the market, right? It's not that I want it for myself. I just see other people getting richer faster than me with a lot less effort. What is happening, right? And these are the moments where our judgment is gone, and we might be making decisions that are not good for us. And I've seen it happen to some really established and seasoned investors as well during the 2020, 2022 peculiar market of the pandemic, when people just couldn't sit on the sidelines. They were doing things they've never done before. And the consequences were as they usually are. Things eventually turn, and the market is pretty brutal when it comes to eventually following the fundamentals, and we've seen it happen. Thomas, I want to ask you about something that came up in this conversation, but you talk about capital light companies. So we talk about the business selection and so on and on and on. But you emphasize the importance of capital light businesses and how they can do better in an inflationary environment. So I want to talk about that because I'm also very curious and attracted to capital light businesses. I think they have an easier time growing. And inflationary environment, it might be something that will come and go in the near future. So I think the two things are really important to keep in mind.
Yeah, so like I love how Buffett describes inflation, right? Inflation acts like a gigantic corporate tapeworm, and that tapeworm is always consuming its required daily diet of investment dollars, regardless of the health of the host organism. And so the more capital investments a company require, the larger the tapeworm. And this tapeworm will be eating away at all the business profits. So especially for companies that, need to hold like large inventories or large amount of inventories, or, need to reinvest heavily back into machineries in order to keep the business sustainable, they are going to be very, very big victims of inflation, because they are always having to reinvest into all these tangible assets. Whereas on the other hand, if you look at a company that are capital light, or, is generating most of its value from intangibles, they generally are less vulnerable to inflation. And in fact, sometimes they do well in an inflationary environment. So when I look at a company like See's Candy, for example, some may argue that, what is going into the value of the See's chocolate is, the butter, the milk, the cocoa, but actually it is the brand. And the brand is sort of immune to inflation. In fact, the company is able to pass on a lot of price increases because of its strong branding. And I think throughout this inflationary period, when I look at the Louis Vuitton, for example, they were raising prices very aggressively throughout this inflationary period. And when the company came out to make a statement, a public statement, they say they are raising prices so that they are able to keep up, with the price increases of raw materials. But if we were to go and look at the gross margins, which is essentially how much they are charging over the raw materials, Louis Vuitton, the gross margins is at an all-time high, right? Even if they didn't raise the margin, the margin is still going to hold steady. So the company is essentially using this opportunistic moment to really drive up the prices of their products. And so when we think about capital-light businesses, in normal environment, they are good for shareholders, because if they don't consume a lot of capital, then all this capital could essentially be returned back to shareholders, or it could be, used to grow the company even more in a value accretive way. And during inflationary environment, because they don't have to reinvest that heavily into all these tangible assets, they are less vulnerable to all these price increases. And in fact, most of them are able to be beneficiaries by continuously raising prices during these opportunities.
So I have this image of a very capital-intensive Berkshire Hathaway in the early days. Jacob McDonough wrote a beautiful book about those early days, capital allocation. And to grow, you need the actual physical space, the equipment, and all of those things become obsolete, and you have to replace the equipment and the machinery and so on and on and on. So you can't really grow without putting up a lot of money. And then at the other end, I have in mind some, we call them, tech platform companies, where you have millions of users, and there's a bunch of them these days. They're connecting us in some way. And the incremental million users costs really nothing. You don't really need to spend a lot of money to serve another million people. But all of it is incremental in terms of growth. So I think the business models, it makes me appreciate more those places where it doesn't require a lot of new capital to add a lot more capacity. And that's where the beauty happens. And in an inflationary environment, you talk about the pricing power. And pricing power is such a tricky concept to really grasp, right? You say, everybody says, oh, I have pricing power. But then they actually get tested, and the consumer pushes back and says no. And then you have, rebates, discounts, 2-for-1, and on and on and on. But having true pricing power that you push, like See's Candy for many years, I don't know what percent it was, but let's say 20-30%, and then it just sticks, and the consumer is willing to accept. Or you talked about Louis Vuitton. That's the beauty. That's where you have the margin. That's where you can have real profits. And that means you created something that the consumer finds truly valuable and is willing to pay up for. And I think pricing power is this, secret power that we only see at times in very few companies. But I think that's what you're going for with this point. Thomas, I want to ask you about the $3 question and the $30,000 question. And I really like this article because it kind of combines more of the personal finance side of the world and then the big picture, investing and getting wealthier part. How there are those jokes about giving up your daily latte, speaking of Starbucks early on in our conversation. And you talk about the $30,000 question. Tell me more. What's it all about? Why it matters?
Yeah. So this actually came from me following or reading a lot of Safety Ramit. So I read his book, I Will Teach You to Be Rich. It's a very cringy title, but it essentially is a personal finance book that teach you budgeting. And, it costs us a pretty big mindset shift in my head, because like you mentioned, a lot of books are always talking about, how lattes or your avocado toast are the biggest thing that's prohibiting you from, achieving financial independence. But the truth is, there are different strategies at different phases of your life, right? If you are living, on monthly to monthly paycheck, then perhaps you might want to cut back on your lattes and stuff like that. But for those of us who are not living paycheck to paycheck, we already have our, let's say our emergency fund and everything already sorted out. There's a limit to how much expenses we can cut, right? And all these lattes, all this is not going to move the needle much for many of us. But what in fact, what we should be focusing on is not this $3 question, but rather this $30,000 question, whereby we should be thinking about how can we increase our income, because there is a limit to how much you can cut, but there's no limit to how much you can push yourself, how much revenue, how much income you can actually try to bring in. And I think that a lot of us, it is not about preventing ourselves from consuming things that we love, but we need to be mindful about how we are spending money, right? Spend money on things that you love, but you got to cut out things that all the expenses that you're spending but you actually don't like. For example, if you are always going out drinking with your buddies but actually you don't enjoy it at all, then you want to be a bit more conscious about where you are spending your resources. And I found one example that Sefti Ramit he gave on one of his podcasts very striking also, because he was talking to this couple who is always comparing across multiple Excel spreadsheets on how to save money on their daily essentials, right? Shopping across the different e-commerce platforms, trying to save that $1 or $2. And when he asked them how much was their combined net worth, and it was a shocking $8 million in net worth, and yet they are trying to save that $1 or $2 every day, and they are not giving themselves the permission to enjoy life at all. And when I heard of this, it reminded me of Charlie Munger's final interview with CNBC, because when Becky Quick asked Charlie, like, now that you're near 100, do you have any big regrets in life? And when Charlie replied, it caught me a little bit off guard. His reply was, I think one of the biggest regret in my life is, not being able to catch a 200-pound tuna. And now I'm a little bit too old and too weak to do so, right? And I think a lot of us, while we are trying to pursue, financial independence, we are always talking about delayed gratification. But there are certain things in life, which is like the 200-pound tuna, you can't delay, right? This 200-pound tuna could come in the form of spending time with your children, with your family, or it could be, hiking up, skiing, and etc. Some things in life we just cannot delay, right? And so like even in the pursuit of wealth, we always want to try and strike a balance some way, because when I think of this, I will think of Jeff Bezos' regret minimization framework. When I fast forward to 80 years old, there are going to be certain things when I regret. And, as much as possible, I want to make sure that I don't miss out on this 200-pound tuna in my life.
I like the sound of that. What you mentioned makes me think of this saying, Pennywise, pound foolish. How somehow we get very comfortable with the small amounts, and saving that dollar feels very real, almost physical, because you can hold a dollar. $30,000, let's say, or $1 million. How much is it really? Like physically, how much is it? And it's harder to imagine. Is it a suitcase? Is it a duffel bag? Would it fit on this desk? Can I carry it by myself? And on and on and on, right? Like physically, it's harder to imagine. And there's this old story, and I don't remember it very well, about old Wall Street 100 years ago, how you would have a lot of people that joined the profession and were trading stocks and on. But they were very comfortable with the pennies and cents, and they were very, very frugal, a lot of them. Maybe it's the Great Depression that shaped them. But then big checks would be carried by messenger boys between offices on Wall Street, and those checks would be worth large amounts of money. I don't know what it was at the time, but probably 30,000 was a lot more than it is today. And there was little care about bringing them around from a building to a building to settle trades at the end of the day. And that image stayed in my mind, because I feel like in life we have those moments where we feel the pennies or feel the dollars, and somehow we don't give enough attention to the larger amounts of money. So people spend all those pennies, and then they buy a stock they heard about on Twitter with the 30,000 that it took them 6 months or a year or 2 years to save. Yeah. And I see it again and again and again, even with people that are dealing with large amounts of money. There's something that we can't grasp when we move from the small amount into a large amount. And if you can be a bit aware of that, I think there's also something special that can happen if you take that larger amount with the responsibility that it deserves. That's how I like to think about it. Thomas, I have one last big question for you. I like to ask my guests about success. And you kind of hinted throughout the conversation, but yet again, let's come back to it. How do you think about success?
Okay. Yeah, so my definition of success has changed over the years, and I think that should be the way for most people. So when I was struggling financially, right, success was to me was becoming the first graduate in the family, becoming financially independent. And now success for me is to work on meaningful projects, hang out with people I like, to grow, and also for me to create an impact in the world, given this platform, I'm provided now. And nowadays, I spend a lot of time not just teaching people about personal finance, about investing. So I like to go to schools or just, give talks to people. So hopefully, whatever experiences I've learned over the few years can actually help them accelerate their own financial independence journey, or to people out there who are having difficulties in their own family situation out there. I think there's a lot more resources that's available on the internet out there whereby we can learn from, and I'm trying to continue contributing to that, and hope that my message one day can help another person who's trying to get out of the poverty cycle.
That's a beautiful way of looking at it and sharing your wisdom and not keeping it to yourself. And I find your story very empowering, and I am glad we got to talk. I'm very grateful that you were so generous sharing your learnings and your story and your lessons, and that you're so vocal about it, and that you found a way for you to express your passion for investing in a way that resonates with you and resonates with so many people. And you found the third door, which is really an inspiration for a lot of people that are thinking about their own pursuits, whether it's investing or not, that there might be another way. And if you ask too many people, you'll hear too many no's. So maybe just find your way to pursue it, and you have. So thank you so much for today. This was so wonderful. I really appreciate it.